Hi, this is John Holohan, and I'll be presenting the Proactive Investment Strategy Update for Friday, February 10th. Well, since our last report, the market advanced a little bit into early February and then gave some of that back in the last, say, week and a half. It seems like there's just an awful lot in the news that have investors concerned. Chairman Powell spoke this week about maybe we're making some headway with inflation, and so moving into more of a disinflationary environment where we still have inflation but at a slower rate. There's still a lot of concern out there about anticipating a recession and when and if that might come. There's other things out there like the yield curve inversion and how that could be a negative predictor for markets. And it just seems like this is one of those proverbial, the market is climbing the wall of worry, a little bit at a time, just making cautious progress. And so, of course, what we're doing is, the theme that you've heard in the last few reports. We're going to continue to monitor our indicators that we consider to be, if you will, the vitals for the current global buy signal that triggered in late November of last year. So we're about 2.5 months into the current global buy signal. And since our last report, we've seen improvements in some of the vitals, and in particular some of the longer-term vitals. But then in the last week and a half, we've seen a little bit of degradation in some of the short-term vitals. So we'll review some of those vital signs. What we're trying to do is track the current global buy signal to see if it's exhibiting characteristics of successful global buy signals in our model history, where we've seen the market trend follow through to the upside, as opposed to those that might have been more short-lived and ultimately reverse back to a global sell signal. So as always, let's start with the dashboard. We remain in that global buy signal that triggered November 30th, so we're roughly 2.5 months into the signal. You see green across the board in the core indicators. The most recent to flip to positive was the long-term momentum indicator at the end of January, and we'll take a look at that. The cash comparison remains positive, and we'll begin our dive tonight into the indicators with our long-term momentum indicator. Here's our long-term momentum indicator, and just a little bit of description here. The black line is the MSCI All Country World Index. Where you see areas of green, that means that the long-term momentum indicator was on a positive reading at the end of the month. White indicates a neutral reading, and then red, of course, a negative reading. So you can see in recent history here, early last year, the indicator turned to negative and stayed negative pretty much the whole year, and now recently, with the January month-end reading, turned back to positive. So this is a good sign. You can see on this chart, if we look back, this period here, for example, in 2012, when after a period of kind of transition here, from negative to neutral, and then ultimately we got a little bit of solid positive readings in here for a while. And you see that was reasonably well correlated with an advancing market, and that happened again in mid to late 2016 into 2017. Now here's some choppiness back in the 2019 period, but kind of started out with a nice uptrend. And then this is the COVID lockdown time period in here. And then after a series of negative readings, a transition to neutral, and then eventually reasonably consistent positive readings here. And then you see a decent correlation with the market uptrend as well. So now after a pretty healthy shakeout of risk here in 2022, it's encouraging to see the positive reading here. So we'll see if this can keep up and we can build some momentum. I do want to point out the momentum calculation on the bottom here is an important one. And one of the things I'd like to note here is it's kind of hard to read here, but the zero line on this scale on this particular momentum calculation is here. And so when you see this indicator dip below zero and then begin to move back up and switch over to a positive slope here, you'll see some decent correlation with market action this way. This period in here, again, dips below zero here and then begins to advance with that positive slope. And, the market had some decent upward momentum at that point. got below zero only slightly here. And again, kind of all the shutdowns in here, so that really took the steam out of the trend. Eventually got ahead of steam after that. And now here we are, you see a dip well below zero, and you see this indicator beginning to flatten out. So we'll have to see if we can gain some upward momentum in this important indicator here. That would be another encouraging sign. And again, coming from so low, kind of an extreme level here, sometimes you can see strong advances coming off of those extreme readings. So this is one we will track closely in the coming months. So with our universe trend indicator charts, we measure the percentage of stocks on positive trends on their individual point and figure charts. On the left, it's the individual logarithmic charts. And we see some improvement here. You see the 2 here. That entry was made in early February. Had a little bit of a setback in the market here the last, say, week and a half or so, but very early February, that 2 is entered. So for every box, that's an additional 2% of stocks flipping from negative trends to positive trends on their individual charts. So, we've seen some good acceleration here. This is one of the longer term vital signs that we look at for, is this global buy signal following a pattern of other successful global buy signals? And so far so good in this chart as well as the traditional version of this chart. And in fact, here we also see an early February entry here. And importantly, this too, the February entry, surpassed this reading from last August, where we had that kind of that high in that ascending X column for this indicator. So, after a pullback and, a nice reversal late last year and some follow through in December and January and now in February, very encouraging to see this development. Again, we're tracking a number of vital signs. This one is longer term in nature. We'll hit on some of the shorter term vital signs as well. And so let's look at a couple of shorter term indicators. Our tactical indicators are both in the neutral zone. First is the 10-week above indicator. Let's take a look at this. So with our 10-week chart, we look at the percentage of stocks currently priced above their 10-week average price in our global universe. And you can see in late 2022, reached kind of this interim bottom here, and then this move up in January, a little bit of back and forth, move up to high risk here, which was reached in late January, and now the reversal down. Overall, we're seeing pretty good action here. We're not necessarily concerned about some of this little back and forth here. Again, this is a short-term vital sign that we monitor for the viability of a fresh global buy signal, but we do want to keep an eye on things. If this were to develop into something more significant, it would tell us that the breadth of the current market uptrend is dissipating, and a potential breakdown here in a shorter term chart could warn us of potentially a more significant shift in the overall trend. But again, for now, nothing overly alarming here with the recent pullback of, let's say, the last week and a half. Here's our overbought, oversold indicator. This is a 1-year view, and you can see how the MSCI All Country World Index was in a generally downward sloping trend. We got our first global sell signal here in April in our model, and you see some follow through to the downside, the market trying to stabilize, and then we got a very short-lived global buy signal here before that trend failed and eventually resulted in our second global sell signal of 2022. Now we've seen the market attempt to stabilize. We'll watch to see if this October low holds, and if indeed this global buy signal that triggered in our model on November 30th develops into what we would typically see with a successful global buy signal. After a shaky start here, we did see the market stabilize into the new year, and now we're right at that bull trend average. And again, not overly concerned about this last, let's call it week and a half, but we do need to see the market stabilize and begin to advance again to have greater confidence in this current global buy signal. Next, let's look at a longer-term breadth indicator. We looked at this in our last report, and we routinely view this as one of the longer-term vital signs of a market trend. And in our last report, we talked about the fact that this long-term breadth indicator was on a negative column of O's here, but now we have seen it reverse back up, so that's encouraging. So this one has improved, but we certainly do need to see continued progress here. A failure here would be of concern, as the longer this global buy signal goes on, the more we need to see those longer term indicators improve, and this is a key one. Just a refresher, this measures the percentage of stocks in our global universe that have positively sloped 210-day moving average price lines. Kind of the next thing we would really like to see is to have this challenge that previous high in the X column and then take it out and of course continue. That would be a very good sign for the viability of the current global buy signal. Next, I'd like to check in on one of the indicators that we review in terms of helping us understand if the current global buy signal is on track with other successful global buy signals in the history of our model. And that's the VIX. The VIX is also known as the Fear Index. It's the CBOE S&P 500 Volatility Index. So you could think of it as kind of an anticipation of volatility in the market. So when there's more fear of higher volatility in the market, the VIX tends to go up. When there is less fear in the market, the VIX tends to go down. So what we've seen in previous successful global buy signals is that the VIX tends to fall over time, and we would expect it would have dropped more by the point we are now in the global buy signal, day 48 into the signal. You can see where I'm pointed right here. The VIX on the day of the signal was right at 2058, and you can see right now it's dropped only slightly. It's virtually at the same level, 2053. In fact, yesterday it was even higher at 2071. So since the global buy signal, again, we expect it to decline to track a successful global buy signal. It kind of spiked a little bit here early in December, dropped a bit, leveled off into early January, and then took a leg down here. And then a lot of sideways action primarily. And it looked like it was going to kind of drop and maybe get some, take another leg down. But now in early February, it has actually risen. And now, again, virtually at the same level as back at the global buy signal. So this is one of those vital signs that we would consider short-term in nature. Again, but we would still like to see progress in this area where the VIX would drop in a more sustained manner and maintain downward momentum. So we're going to keep a close eye on this one. With it being short-term in nature, it's kind of one of those early warning signs for us. Next, I wanted to check in on some things that, kind of observations as a result of some of the Fed's actions, primarily, I believe. Now, first one is U.S. M2 money supply. Just retracing a little bit of history here in recent years. You see how the money supply has generally been rising, and then right here we see a big spike up. That's a result of the injection of liquidity into the system as a result of the lockdowns associated with COVID, the shutdowns and lockdowns, and all of the efforts to try to keep the economy going. But then you see things continued on an upward trajectory to a peak in March of last year, March of 2022. And since then, and this is something you don't see very often, but since then, kind of a contraction of the money supply. So rough numbers, about $500 billion contraction since the peak in March of 2022. So funny how we speak in trillions now. We used to speak in billions, and that used to be a big thing. But at any rate, pretty big contraction. That has been a big contributor to, coincident with the inflation rate decelerating, coming down, having the so-called disinflation that Powell remarked about. But that's also, less money to chase equities as well. So maybe we count this as a little bit of a negative for the outlook for stocks, but we'll keep an eye on this and see if this trend continues. And a somewhat related chart, this is information from the Fed about the balance sheet of the Fed. On the St. Louis Fed website, they put gray in the background for recessionary periods. So you see the real estate bubble back in 2008, into 2009, that recession, and then the recession associated with the shutdowns and lockdowns in 2020. And so you see the actions of the Fed back here when the economy really ran into problems with the real estate bubble bursting. You see a big injection of liquidity in the form of the Fed taking assets and supporting asset prices, taking assets onto their balance sheet, and a little back and forth here, and kind of continued asset purchases on into well into 2016. It wasn't until really in earnest in 2018 that you began to see the Fed remove assets from the balance sheet. That's the so-called tapering of the Fed balance sheet. And then late 2019, you see a little bump there. And then you just see this huge spike related to the shutdowns that we had in 2020. And just a continued little bit of a blip down there, but then just this continued rise up to a peak somewhere similar to the peak in the money supply, early 2022. And then that's the point where you begin to see assets rolling off of the balance sheet. If you'll permit me to use rough numbers, of about $500 billion came off the balance sheet from the peak in the spring of 2022. If this continues, we'll have to see what effect it has on equity markets, continued shrinking of the Fed balance sheet, continued shrinking of M2 money supply. We'll have to keep an eye on how those actions might affect equity prices. Well, there are certainly a number of things that could cause this market to stumble, some of which we've covered here. And to me, this market does have a feel of climbing that wall of worry. With the market model on a buy signal, of course, we want to participate, and of course, we want to be selective. And we use that market model in conjunction with our recession warning model. And we've reported previously how that has recently warned us of an elevated risk of recession. And so that's why we want to proceed cautiously. As you can see in today's report, we've got shorter term indicators that have degraded a little bit, while some of the longer term indicators have improved. So we'll continue to monitor those vitals for the current global buy signal. Our objective is to see if the current signal exhibits characteristics of successful signals that we've had in the history of the model. We believe that by monitoring these vitals, it can help us understand if it's appropriate to keep the foot on the gas or even put the foot on the gas a little more, or whether we should prepare portfolios for the potential of a reversal in the signal and be more in a capital preservation mode. Too early to reach the conclusion either way right now, so we're going to try to take advantage of what the market gives us for now, but again, proceed very cautiously. And in one of the upcoming reports, we'll give an update on the recession warning model and see if we can get any potential clarity on that front. In the meantime, thanks for watching, and we'll see you in 2 weeks for our next report.